Thank you for joining us. I'm John Reade, Chief Market Strategist for the World Gold Council, and I'm joined today by Alasdair McKinnon, Manager of the Scottish Investment Trust. Ali, great to speak to you again.
Hi, John. Likewise.
So, look, I've got a couple of questions that we're going to put to you. The first of which is, look, the past 12 months has been unprecedented. And as the global economy begins to recover from the pandemic, we've seen strong gains in many asset classes. What are the key themes you're looking for now?
I mean, you're right. Look, no one could have anticipated what we've seen over the last 12 months. I mean, even in the wildest dreams, I don't think even the most extreme blogger of weird theories would have come up with this. But at the end of the day, what we've seen actually is an acceleration. I know this is something everyone says, an acceleration of so many trends. But what I think is most interesting in terms of asset classes is the acceleration of the inflationary trend. Governments were already printing money out of thin air to try and keep the show on the road. And COVID took that to a whole new level. We're now subsidizing effectively large parts of the economy and the workforce. And the interesting thing is, now that's started, it's really, really hard to stop because, funnily enough, people like it.
No, absolutely. The free stuff's popular. And I guess your view certainly fits with your allocation. The trust has a meaningful exposure to gold mining equities. So how does that fit into your overall strategy?
Well, we are what we call contrarian investors. So what we really focus on, where we think the only inefficiency that's in markets is out of favor areas, because there's so much pressure on investment managers to perform. You know, you've got to perform every day or every month or whatever it is. And if what that means is it causes crowding. People crowd into things that are doing really well. They want to buy them, and things that are doing really badly, they want to ignore. And of course, there's really good reasons why. You know, for example, the things that are doing well have always got a good story behind them, and often have a really good fundamentals as well. And likewise, things that are done badly, they do badly for a reason. There's always they get out of favor for very good reasons. But I think why have we got so much in gold miners? Well, it's really simple. You know, we see gold as a hedge against inflation. We don't necessarily expect you'll make real gains in gold, but we think it preserves its purchasing power. That's what recorded history seems to show. And the gold miners in particular, why are they unloved? Well, because frankly, for 20 years, since the gold ETF came along, in the first one in 2004, people have said, well, why would I take a risk on a gold miner run by management teams who frankly don't seem to be aligned with the shareholders? I'll just buy the gold ETF instead. But today, that's all changed. The gold miners, in a market context, look quite attractive investments, we think.
Do you think there's been a meaningful change in management approach compared to the last spike in gold that we saw back in 2010, 2011?
There seems to be. I mean, basically all the management team, I mean, you never know. I'm sure if gold enjoys a really good strong run for a few years, it's just human nature that bad habits will re-emerge. But having been through what was effectively a disastrous crash from 2011 onwards, the management teams, generally speaking, have completely changed their whole philosophy. They're very focused on generating cash. And you've seen these huge mergers among the big players in the industry. And that would have been unthinkable 20 years ago, even 10 years ago, it would have been unthinkable because, frankly, people liked having a little empire and they didn't really want to lose their jobs, obviously. And but that's all changed. So that is the biggest change. And at the minute, and I think for the foreseeable future, the management teams are all saying the right things.
Good. Well, that's good to hear. You have the benefit of being able to take a long-term view, I guess. I mean, Scottish Investment Trust has been around a long time. Talk to us a little bit about the organisation.
Well, we've been around since 1887, and actually we're still in, and obviously we were founded to, I guess it was the great and the good of Edinburgh wanted to invest their money overseas. And actually we've got this first report and accounts, which I believe is on our website. And it's literally one page, and it sort of folds up into kind of a third the size of a piece of A4 paper. And that was the report and accounts. And what's really interesting is I've shown this to quite a few finance directors over the years, and they always say, you know, compared to, say, the 400-page things you've got these days, and they always say, oh, I wish accounts were like that today. And by the way, this one page is actually more informative than the 400 pages we're forced to produce. So we've been around that long, and actually we've the same building since 1889, albeit we obviously haven't been there in the last year. But just another interesting fact, apparently we've got, or what was once, the best safe in Edinburgh. It's got so many doors into it and locks and keys. I've never even been in it. It's so hard to get into. But it's because obviously the securities we still do hold, but it used to be if you held a bit of paper, that was worth money.
No, absolutely. So aside from gold mining companies, do you see any other pockets of opportunity that you're looking for, some contrarian investments that you think might perform well over the next few years?
It's basically unloved areas of the market, which tends to be at the minute. There's a general view that value is undervalued, if you see it to me. There's been a big drive in recent years to chase what you might call technology firms, disruption, exciting growth stories, concept stocks that lose money. These are all very exciting things to potentially invest in. And I can totally get why people do it, because frankly, 20 years ago in the dot-com era, well, actually, at first, I didn't really believe it. Then I kind of had a go and thought, oh, actually, I seem to be making money here. And then I got kind of caught up in the crowd. And I think that's sort of happened again. It's different, but it's happened again. So what are people overlooking? Well, they're overlooking the stuff that looks a bit boring. And they're overlooking, for example, energy is one area of the market where people are saying, well, we don't like it for ESG reasons. We don't like it because we think, never mind ESG, oil is just in decline. We don't like it because, they're big, boring companies. We don't like it for all sorts of reasons. But actually, we look at, say, the oil majors, say a BP or something, and we say, well, actually, look, it's got a really good ESG strategy. It's got a decent dividend yield. And by the way, oil and gas isn't going anywhere, in the foreseeable future. Now, I know a lot of people would say, so what? It should go away. You shouldn't own it. But we'd say, well, look, it's absolutely essential to civilization that we have energy. And the renewables are not there yet to fuel a modern society. So we think it's an essential thing. And it's really being overlooked by the market in the I don't know, I guess this kind of mania for stuff that's already gone up a lot, if you see what I mean.
No, I completely get it. And look, I think we have to accept it's going to be an energy transition rather than an energy full stop. So I can certainly see why sectors such as those could easily have been looked behind. Well, Ali, thank you very much for your conversation. It's fascinating to hear both the story of Scottish Investment Trust, but also the way your philosophy and your look for contrarian investments, particularly in an environment where there's been some really fantastic gains made in some of these tech stocks, these, as you say, non-revenue or non-profit stocks, and maybe that comes to an end. So I'd like to thank you very much for your time today.
Thanks, John.